An IRS installment agreement is a conditional contract. When a taxpayer defaults, the IRS is immediately released from its obligation to hold collection actions. The formal notification of this contract breach is the CP523, Notice of Intent to Terminate. This notice initiates a 30-day countdown before formal termination occurs. At day 0, the agreement is terminated. At that point, the IRS is authorized to levy bank accounts, wages, and property. Within this window, a practitioner must execute a specific sequence, identify the exact cause, cure the default, and request reinstatement or an alternative resolution. We are going to analyze 3 distinct default scenarios: a medical hardship, a new tax liability, and a second default, to map the correct response protocols. The 30-day CP523 window is the practitioner's complete working timeline. Every day of delay restricts the available survival options. To cure a default, you first have to diagnose the exact breach of contract. This chart shows the 4 compliance failures that trigger a CP523. The most common trigger is a missed or late monthly payment. The second is a failure to file a required tax return while the agreement is active, which violates the condition of current compliance. The third is incurring a new tax liability, such as failing to make estimated tax payments, which voids the parameters of the original agreement. The fourth is providing false financial information during the original negotiations. This results in termination even if all payments remain current. Reinstatement requires a current account. A practitioner must diagnose and cure the specific cause of the default before contacting the IRS. Consider Sandra. She had a $78,000 balance and a compliant track record of 36 consecutive on-time payments. A medical hospitalization caused her to miss 2 consecutive payments. The IRS issued a CP523 notice. She retained a practitioner on day 4 of the 30-day window, allowing the practitioner to execute the full procedural checklist. The first priority was curing the default. Before contacting the IRS, Sandra made both missed payments to bring the agreement fully current. For first-time defaults with a documented, correctable cause and a strong compliance history, the IRS can reinstate the agreement without a new financial investigation. With the account current, the practitioner contacted the IRS with the medical documentation to request the one-time reinstatement provision. The agreement was restored in 23 days on its original terms, halting all pending collection actions. 36 on-time payments provided the evidence of genuine intent required to bypass a new financial investigation and secure the reinstatement. Next is Marcus. He maintained a $43,000 installment agreement for 14 months. Then he incurred a new $19,000 liability caused by insufficient current year estimated tax payments. A common misconception is that a practitioner can simply pay the missing monthly fees to restore the original agreement while ignoring the new debt. Because installment agreements require current tax compliance, a new tax bill fundamentally breaks the original contract. Marcus could not request a standard reinstatement. Instead, the practitioner had to negotiate a modified installment agreement that absorbed the new debt. Since the total debt load increased, the practitioner submitted an updated Form 433F to calculate a revised monthly payment. The IRS accepted the modified $62,000 agreement within the 30-day window, preventing the levy. A new balance is a systemic compliance failure. Resolving it requires merging the debts and structurally rewriting the payment contract. Finally, look at Patricia. She carried a $112,000 balance, but she had already defaulted and been reinstated once before. A business downturn caused 3 missed payments. She did not contact her practitioner until day 18 of the CP523 window. Standard IRS policy allows for only 1 reinstatement. Patricia's second default made that provision permanently unavailable. With reinstatement unavailable and only 12 days remaining on the clock, the practitioner had to pursue an alternative resolution. Because her income had declined, the practitioner drafted a Form 433A to request a Partial Payment Installment Agreement, a PPIA, on lower terms. The practitioner requested a levy hold concurrently with the PPIA submission to freeze collection while the IRS evaluated the new financial data. When the one-time reinstatement is exhausted, the only way to prevent a bank levy is the immediate preparation of accurate financial documentation. These cases illustrate 3 distinct CP523 pathways: a baseline reinstatement, a modified contract, and a PPIA pivot. Resolving the immediate default is only the first step. Because a second default was fatal to the agreement, a practitioner must implement prevention systems. The strongest tool is converting to a direct debit installment agreement to eliminate missed payments. Secondary tools include enforcing quarterly estimated tax grids and setting calendar alerts for all filing deadlines. For enrolled agent candidates, Domain 2.3 requires mastery of the 30-day operational window triggered by the CP523 notice. The exam tests your ability to differentiate between a one-time reinstatement and a situation where a new balance requires a modified agreement. You must also recognize that a second default necessitates an immediate shift to alternative resolutions, such as a PPIA or currently not collectible status. Time dictates strategy. The practitioner who engages on day 1 controls the available paths. The practitioner who waits until day 29 faces unavoidable collection execution.